Welcome to this presentation on historical volatility, a fundamental concept in finance and investing. In this session, we'll explore what it is, how it's calculated, its importance, applications, and limitations. Let's begin with the basics. Historical volatility measures how much an asset's price fluctuates over a specific period. Expressed as an annualized percentage, it reflects the level of risk or uncertainty in an asset's price movements. High volatility means larger price swings, while low volatility indicates steadier prices. How do we calculate historical volatility? It's based on the standard deviation of the asset's daily returns over a given time frame. This value is then annualized by multiplying it by the square root of the number of trading days in a year, typically 252 for equities. Simply put, higher standard deviation means higher historical volatility. Why is this important? Historical volatility helps investors and traders assess the risk associated with an asset. It's particularly useful in pricing options and financial derivatives, where price uncertainty plays a critical role. Moreover, it provides a basis for comparing the risk profiles of different assets. However, historical volatility has its limitations. Since it's based on past data, it doesn't predict future market movements. Sudden market shifts or anomalies may not be reflected. Therefore, it's best used alongside forward-looking metrics like implied volatility. Historical volatility has several applications. For options traders, it's integral to pricing models like Black-Scholes. Risk managers use it to identify high-risk assets, while portfolio managers leverage it to balance portfolios with a mix of high and low volatility assets for diversification. Here's a quick comparison. Historical volatility looks at past price movements, while implied volatility represents the market's expectations of future price changes. Together, they provide a more comprehensive understanding of market dynamics, especially for options traders. Let's take an example. Imagine two stocks, one with large frequent price swings and another with a steady upward trend. The first stock will have higher historical volatility than the second, indicating greater risk or uncertainty. A graph or table can make this comparison clearer. In summary, historical volatility is a valuable tool for assessing risk and understanding market behavior. While it's insightful, remember to pair it with forward-looking metrics for better decision-making. That concludes our presentation on historical volatility. If you have any questions or want to discuss how it impacts your investment strategy, feel free to ask.